hopefully. Hello, and welcome to episode 8 of the Bitlemmas podcast. I'm Watson. I'm here with B Sovereign of the Bitlemmas group. Today is a book review of Layered Money by Nik Bhatia. The real story of this book is that money isn't one thing, it's a pyramid of layers of claims. In calm times, the top layers feel like money. In a crisis, everybody tries to fall down the pyramid into settlement. If you remember one thing from this episode, the question isn't what is money, it's what layer is your money on and who controls the conversion into settlement. In the next hour, you're going to leave with a map you can reuse. You'll be able to look at any money system, gold, dollars, bitcoins, even CBDCs, and locate the layers, control points. We're going to review 4 claims from the book. Money is a hierarchy of layers. So that's a pyramid of claims. Layers scale, but they add trust boundaries. There's a pivot layer where claims convert into settlement, and that's the power position. And also, Bitcoin creates a new base layer, and CBDCs are a response to that base layer and really a fork. So, if you're not finance native or Bitcoin native, don't worry. We'll define the minimum in plain English, and then we'll do concrete examples. And we'll also have some questions to contemplate for you at the end and how you can audit your own stack. Now, what are the core claims and the thesis of Layered Money by Nik Bhatia? Money is a layered hierarchy, like we said. It's a pyramid of claims. There's a base layer, and that is where settlement happens. We're going to talk a bunch about settlement. It's the hardest to fake layer, which is important. You have upper layers, and the reasoning for having upper layers is convenience. They're going to be faster, so on and so forth. We'll talk about that. But there's a trade-off, and you're going to require, it's going to require you to trust people more. We'll talk a bunch about that. Governments want to control the pivot or the authority, or anyone who wants to amass power. They want to control the pivot layer in the author's description, and that allows them to control the system. We'll dig deep into that. Now, as far as Bitcoin, that creates a new base layer, but you still need to have layers. So all of these are going to be quite interesting to dig into. Now, we're at a crossroads. Digital money, and when I say digital money, you can think of Visa, right? It's changing. We have a vocabulary when we talk about money, someone off the street talking about money, someone with an economics talking about money. We have a vocabulary that struggles to fit Bitcoin and CBDCs. Again, when I say that acronym, I'm talking about central bank digital currencies. It struggles to fit or describe those two technologies. Layered money is a map, and you can use it to locate your money, your assets, and where they are and which layer, and that's going to help you to reason about these trade-offs. So if you can navigate the layers, you can choose between trade-offs better.
Mm-hmm, mm-hmm. And I this is the perfect lens for anyone who feels like the system is closing in. The old vocabulary of cash and digital money fails when you have Bitcoin and CBDCs. The layered money model is how you locate your assets. It's the difference between thinking that you own money and knowing what kind of claim you actually have. If you have to navigate the layers, you can make better decisions if you know how to navigate them.
Exactly. Now, let's start out with a minimal model of layers. We're going to go through this multiple times to try to help use it to help us to reason about our money. So, layer one, the bearer asset. What is a bearer asset? When you have a bearer asset, let's describe it a little bit. You have control. Again, we're going to talk about what settlement is, but you have control of settlement. One of the things that means is you don't have to ask permission from what's called an issuer. You don't have to ask permission to transfer that thing. So if you have, this is where it can be confusing when we're talking about the layered money, but someone off the street, they'll think about paper dollars. If you have paper dollars and you go to exchange that with another person, you don't have to ask permission. So in one sense, it's a bearer asset. On the other side of that, with a bearer asset, the settlement is final. So in this sense, if you exchange the paper dollars over to someone else, you're going to have to go find them and wrestle the paper dollars, physical dollars back from them in order to get it. There isn't some other system. Now, there's layer two, claims, right? So now, if you start to think about, when I'll talk about gold, if you have gold coins and you have them with some goldsmith, some gold company, and you have a certificate, that certificate is a promise. That's a claim on the gold. That's going to be at a higher level at layer two. But what's the promise? The promise is to exchange for settlement. What does that mean in this sense with the gold? You have gold coins. Let's say you deposited with a bank and you have some certificate or whatever. You go and you say, here's my certificate, give me the gold. When they transfer that, that's an exchange that from the layer two into the layer one. Now you have the gold, and it's also settlement. They transferred gold to you in your hand. Now, when you're thinking about layers, you can think about balance sheets, but the person off the street doesn't really know what a balance sheet is, right? So now, remember, there's an idea or concept of a ledger. What's a ledger? It's a recording of who owns what. Now, with double entry accounting, which we'll probably talk about some, there's also who owes what. It's another kind of ledger. It's a more advanced ledger. So you have who owes what, who owns what, I'm sorry, who owns what as a most basic, and who owns what. So who owns what is assets. Who owes, that's liabilities. That's now you can have more sophisticated layers. We're going to get into that. But that's the idea of when you're this concept of a balance sheet. Now at the higher layer, you have easier payments. Why? We'll talk about this repeatedly, but it's easier to exchange a certificate or a note or a piece of paper or even change a digital account from on one person and then it again on another to transfer payments. So that's at the higher layer. It's we're going to talk what is it, what do we mean when we say payment versus settlement? But you need to have higher trust. You're going to have to trust whatever it is in between you and the other group that you're paying. You're going to have to trust that entity. You could call it a counterparty or third entity. Now, also, when there's a crisis, so when there's instability, then there's going to be a revelation of what the real layer is. What does that mean? When people have a claim, we'll talk about claims repeatedly, but when people have a claim, you can think of, let's say you have gold coins and you have a claim on a gold coin. So that's a coin, a gold certificate. When people no longer trust that claim, that promise, or they start to have anxiety about it, they go and redeem it. They go and say, I want to go from a higher level, I have claim, that's layer two, to a lower level, which is settlement. I want my gold. You can also, that's an easier way to think about it, but You can think of paper dollars, and you think you have $10,000 in the bank, paper dollars, and you think you can go. You really have a claim on the 10,000 paper dollars in the bank. And you could go there and say, I want my 10,000 paper dollars. And they could tell you no if they want for various different reasons. So that is when there's a crisis, then you have a revelation of what is actually the real layer.
Yeah. And I do want to bring in a just an historic example. This we could kind of relate this to the US. Back in 1971, the US had come off the gold standard. Um, that was for years prior, it was where you could get $35 to 1 ounce of gold. Um, when that standard was removed, you could no longer redeem an ounce of gold for $35. And I think that that's a good segue into what we are going to go into next.
Right. So you have gold coins and gold certificates. This is probably the best way to understand layers and really maybe to understand money, because people can understand gold and gold coins as something physical and valuable, because you can think of it as jewelry. It also has industrial value. You can use it to create things. But think of layer one as a gold coin in a vault. And that's bearer settlement. We already talked about what bearer means. You have the gold coin in your hand and you transfer it. That's final settlement. Now, layer two is the gold certificate. And you can, now there's various ways to reason about the morphing of gold certificates. So you could have a gold certificate that has your name on it and says, I can redeem this when I go to the goldsmith, which morphed into banks. I can redeem this for the gold. And then it became more of a bearer asset when the name could either be crossed out or there's no name on there, and you could actually just exchange the certificate with another person. So you don't have to exchange gold, the physical heavy thing. You can have a gold certificate, which is concealable. You can bring it between different cities, all these types of things, as long as you trusted the counterparty, or the third party, the issuer in this language here, the person who issued the certificate. So that's layer one. Layer two, both are money. So the author is trying to get you to reason and abstract. This word money is ambiguous. You know what it is because you use it all the time, but you have a cell phone, you don't know how that cell phone works, right? So you know what a cell phone is, but you don't know how it works. You know what money is, but money's more deceptive than a cell phone because you really think you know how it works. The author is saying, reason about it with these layers, and you'll be able to understand the ambiguity. So now both are money, but they're not the same thing. And this is the simplest layered money example. Like B Sovereign said, we have a history, and we'll talk about it again later. But there's a history of, we had the simple world where you had your notes, your what you call a dollar, your paper dollar. It says on there, it's a promissory note. It literally, you used to be able to redeem it. We're going to talk about that some more later. Right. So again, gold coin, gold certificate. You got layer one on this diagram. Layer one is the bearer settlement. You could imagine you exchanging the gold coin with someone else. You exchanging it with someone who's holding it in a vault for you. Right. It's harder to move, but it's final. That is a thing to keep in mind. The higher level, you have gold certificates. You can exchange that paper easier, but it depends on the issuer who issued. Issuer means they issued a certificate to you. And there's all types of power that you gain from being an issuer. We're going to get into that. But it's a claim. A certificate is a claim. It's an IOU. It means you have a piece of paper that says that an IOU. So what is that? Who owes you? The person that has the vault. They owe you a piece of gold. Uh, so there we go with that. So now, again, with coins, what's the significance of coins? It's interesting to understand this because it's a better way to reason about money, and then you go into the layers. So coins standardize weight and purity and unit of count. What is that? Why does that matter? Because before, historically, you had goldsmiths, you could exchange gold with certificates, and it was just gold, right? So first people are exchanging gold, then you had goldsmiths who held all the gold and you could exchange certificates. But then you had debasement. You had the actual goldsmiths saying, okay, here's some coins for you. The coin will verify that this gold was made by me. It's very cool and very popular goldsmith. I made this coin. And that allows you to people to see the coin and transfer it. So that's a gold coin. And then you have the certificates because there was a gold that the gold coins were too much, right? But you had debasement of the gold, right? So this is before the issuing of certificates. You have debasement of the coin. What does that mean? So if I issue you, a quarter of an ounce of gold in a gold coin, and it has and you trust me, I'm the goldsmith of Florence, and everyone loves me. Okay, but now everyone loves me. Now I can debase it. I can shave off some gold, give you
Mhm.
less than a quarter of an ounce, and now you have a problem because your gold is worth less, but they trust me. But I can
Yeah.
make more gold coins out of that, so I can go and basically rip you off, right? So I'm stealing, but I'm not the government. I'm just a regular person. This is going to morph into government later,
Mhm. Mhm.
right?
And it's
Go
and
ahead.
I think the key term here to remember is just there is so much trust that is required with this when you're dealing with allowing the issuance to come from a primary party. You are saying that they are going to do right by you, right? That they're not just going to be shaving off gold coins. They're going to give you exactly how much gold coins there are. They're not going to print too many certificates on the gold that they have in their storage and just start wildly giving it to everybody else because they know that they can also in turn make money from issuing these certificates as well. So it's just making sure that there is a ledger that is visible to everybody that is interacting with these institutions
Yeah,
to keep
there's fit.
people honest. Yeah.
Yeah, there's 50 ways from Sunday to rip people off. There's debasing the actual gold, the physical. So just
Mhm.
because you're dealing with gold and you have gold coin doesn't mean that you don't get ripped off. There's debasement. Then you can
Mhm.
also do what we call fractional reserve banking now, which is we just basically made the scam, you could call a scam. We basically made that legal. It's no longer a scam. So what they were doing before, where they would say, I have $10,000 worth of gold coins, but I'm going to issue 20, 30, 50, 100, $1 million worth of certificates, but I only have 10,000 worth of gold coin. And you can really think about this as a musical chairs. There's 5 chairs, there's 30 people. Everyone comes back in. There's only 5 chairs to that people can sit down in. So this is the game. Now you have layers emerging. Monetary systems become hierarchical layers. This is kind of the one way to think of the fundamental idea of the book is hierarchical layers, obviously. Bills of exchange, they're promises. You have IOUs, you have claims, you have bills of exchange, these types of things, right? Credit instruments. So we're talking about this morphing, which I hinted on earlier. Then you have, right? So again, at this point, you have certificates, bills of exchange, right? Then you have double entry accounting, which I think was around 300, 400 years ago. What is that? Remember, you have one type of ledger, which is who owes what, right? So you can think of a piece of paper that says this Johnny owns, I said oh, but owns. Who owns what? So Johnny owns this barrel bushels of rice or whatever, and Jack owns this other, bushel of rice over here. You could say that with gold, whatever. Then you have who owes what. That's double entry. So you have owing, owning, and owing. So you have this morphing. Now, what does that allow? That allows for more advanced kinds of money, which you have assets, owning, and liabilities, owing. Now you can have a way more confusing kind of money, but more advanced money. So a two-layer system forms the florin, which is Florence, a Florence gold coin, let's say, out of Florence. And then you have the bill of exchange, which you could think of as a certificate.
Mhm. And before we go forward, I want to talk about, assets for one, right? In the business world, and I mean this is global, an asset is equal to your liabilities plus equities, right? Assets are what you own, right? Liabilities are what you owe, and your equity is how much you have inside of your assets, how much ownership you truly have. All right. Now let's move forward.
Central banking. Government sees what the author calls the pivot layer between layer one and layer two. What's the pivot layer? The pivot layer is, remember, if you're on a settlement layer, you don't have any you don't have to get any permission from an issuer. You don't have to get any permission to exchange. The pivot layer, that's where you have an issuer or custodian, but they set the terms for the conversion into the settlement layer. So they have control of this conversion, right? So you have they have the note, promissory note, and you want to convert it to gold. They're the ones that decide to convert, how to convert, the terms of it, and all of that. That's the pivot layer. Central banks insert themselves into the pyramid, which central banks and the governments are together. Now you have mandated denomination, which is another incentive system, another incentive capability of government. So they could say, you must pay us in this type of money when you pay your taxes. So you can have whatever you want, rice, gold, carry shells, whatever, but you're going to pay us in these things that we decide. So we're going to print some paper and you have to pay us in this paper. And we're going to decide how much the paper is worth. You also get the central routing where whoever it is that controls the pivot layer, depending on how much they can record the ledger, they can also surveil. And that gives all types of power with seeing relationships for everyone who has to interact, which basically everyone, with the money system. Now we have this diagram for who controls the pivot. It's best to look at it from the bottom. You're looking at settlement again in your mind. You can imagine this as well. Base money. Now it's easy to think about gold as settlement because you can think of gold coins and exchanging. But we're going to talk about treasuries, and then it becomes more difficult to understand. Then you have the pivot layer where you have central bank money. We're going to talk about central bank money, but you have reserves and notes. So reserves, like, okay, it's easy to think about when you have gold as reserve in the bank, in the vault, right? But they are able to say, oh, you're coming in, you have an IOU on the gold, right? Which is used to be a dollar, right? You could exchange dollars for gold. Uh, but they determine, right, the exchange, the terms. So what ended up happening, like what B Sovereign said, is 1971. Nope, we're not honoring that anymore. So you had whole countries like France that had tons of IOUs for gold, and then we said, nah, maybe we're not going to honor that. You better come try to get it. And then you have bank deposits. So this one's counterintuitive. You have paper dollars, someone off the street, you have paper dollars. Let's say you take 10,000 paper dollars and you go to the bank. and you say, I have money in the bank. No, you don't. You have a claim on money, those paper dollars in the bank. And they could tell you no in many ways when you go to say, give me these dollars. So you may think, well, there's insurance. That's also a claim. Again, these are all things to make you trust the system. What I say make you, but there's different types of mechanisms for increasing trust to build the trust in the system, but their trust on the claims. And so it allows you to, this model allows you to reason about the different layers.
Mm-hmm. Mm-hmm. And really, the further that you are from the settlement layer, the more manipulation you are prone to, because you still have to go through layer 2 and then layer 3, right? Layer 3 with the bank deposits, your claims on the bank, essentially, you have to make sure that the bank is doing right by you, right? And with the central bank money, you have to make sure that even the gold that your reserves are backed by isn't manipulated as well, right? So you really want the most trustless system possible. And I mean, I really do think that there are, alternatives to that, to be quite honest with you.
Exactly.
All right.
Now, a little bit more complex discussion, which could be its own review. But the Fed system. You have central banks issuing what we call layer 2. Remember, those are claims on liabilities. Okay. What is that? Reserves. Okay. It used to be gold, but now it's treasuries or debt. We'll talk about that some more on another slide, but this is the central bank and the idea of what money is for a central bank layer. Then you have banks, which is confusing because you have banks and central banks. You may think, oh, they're all the same. No, there's different types of banks. So they issue layer 3 deposits on top of that. What do you mean by that? When you went to the bank and you said, here's 10,000, like I said before, they issue you a claim, like we owe you 10,000 paper dollars. You have a claim on it. So in a sense, the one of the more confusing things when trying to reason about money is claims and the issuer of the claim. There's a position or a framework of thinking about money as that it's all claims. And it is the proper way to create money out of nothing. And it's the valid way and it's good for the economy and all this stuff like that. But in any sense, you really do have a creation of money even when you do the deposit. So there's different layers, but you really should think about it as the central banks are the ones that are issuing and lending and creating money when they issue it to the other banks. Then you have the dollar pyramid, which becomes what you could call one way to describe it is we call it the exorbitant privilege of the United States, where we have the dollar and everyone does global exchange based on the dollar. So one big group obviously that does it is Europe, and you have the European dollar in that way. As far as this behind the scenes layer that global exchange is working on or uses. So all of this is confusing. We might get a little bit more confusing. Some people would say it's confusing on purpose, but regardless, we have the complexity growing and then you have fragility. So the system is fragile. How? When you don't understand the risk, then you will have no problem with accepting higher and higher levels of claims. And I say you, it could be anyone. It's not just you, it's sophisticated investors, so on and so forth, where how fragile the system is how it's hidden behind who is at the pivot layer, who controls the terms of moving from a higher level to a lower level of this redemption. And it's hidden. So the author critiques that.
I truly think that I mean, the Fed system, the monetary system, just in general, is it's something that is not touched in grade school the way that it should be. I mean, most people really don't even learn about, personal finances, just general topics of how to budget and save. So there was a point in time in history where most people knew what money was, right? Because you could physically hold these gold coins and things like that, stuff that was not as easy to manipulate, but it still could be. Um, but just kind of going forward, this was not always the case. They were not always these complex financial systems. And as Watson had alluded to earlier, it's complex for that reason, because it's easier to manipulate in that regard.
Exactly. So now here we talked about this already, but the whole retiring of gold. So in 1971-ish, I believe, we were on a gold standard again. You have your notes, what you think of your paper dollars, and you could redeem them. You could go and get gold. Most people that know this story, they know of that, but one of the bigger risks or events was other countries had lots of these dollars that they were saying, okay, we can always, United States is holding the gold for us. And then Nixon said, well, we're no longer redeeming the dollars for gold. Sorry. And so that was this whole idea of gold is no longer the base layer. Then the next event was treasuries become the first, this first layer, collateral. What is collateral? This idea of if you want a loan, the thing that you put up to back the loan. So if you, there's the loan giver and the loan taker, right? So if you get a loan and you put up collateral, people know putting your house up for collateral for a loan. When you don't pay it, they don't service the loan, you lose that collateral, the house, to the person that loaned you. So now you have treasuries being the collateral, which is confusing because the treasuries themselves, when they're issuing it, that is itself a debt. It is saying, oh, the people are going to, the taxpayers are going to pay the government. So don't worry about it. When we issue this treasury, it's collateral. You have the right to this collect. I'm going to say it this way. You have the right to collect this tax. You don't, obviously, but you have treasuries that now become this collateral. And then you have this repo market, what they call a repo market. And the author has a lot of material on repo markets and describing treasuries and all of this, uh, in their YouTube channel and so on and so forth. But this is the repurchase agreement market. What this ends up doing is allowing this new base layer to be collateral. It makes it more liquid. So people are exchanging. So when you have liquid, remember the idea of liquidity, you can imagine, let's say you have gold and you say, I want to buy a Ferrari and the Ferrari is $500,000. You have $500,000 worth of gold. Okay. I want to buy the Ferrari. And you go to the dealership and then they say, you have this gold, but we don't want that. And you say, well, okay, how about I give you $1 million worth of gold? They may take it, right? But that extra 500,000, that's the discount. That's how much you had to basically pay them to take gold. So it's less liquid in that sense. How much more liquid you are, the less discount you have to do to the exchange. That's a way to think about. With this repo market, it makes the treasuries very liquid. And then, so the dynamics of that affects the idea of money and the base layer, right? So that whole choice of treasuries being down there, now that reshapes the whole pyramid. Now the author's view of trying to take this money layer model and applying it to 2008. So you have derivatives, you have people, you can call it making bets on bets, but it outscales the safe collateral. Again, we described what collateral was, and then that made the market more fragile. Why did that matter? You have banks who loan from each other and borrow from each other, and the banks themselves start saying, hey, we are not going to loan as much and we're not going to borrow as much now. And so you could call that a system freeze because of the instability of the derivatives and all of these other things that, will be too much to go into. But the thing that the author wants to highlight is you have the Fed, right? Remember the layer 2, they become the lender of last resort or only resort. So what does that mean? So if the banks are no in the system that we're talking about with all of these layers, and remember money being creating and issuing of claims being money, and they say, well, we're not going to issue more claims. Now you have a freeze and the money stops coming into existence. The Fed comes in and says, oh, you're making risky bets. We're going to cover all of that for you. We're going to bail you out. And then that's what happened. But now you have a new problem. That stability was created from this backstop, this layer 2, the Fed and government. But now you're rewarding people who take risk, too much risk, you could say, which whatever the people who caused 2008, they got rewarded. And so now you have this, perverse incentive.
Yeah. When we talk about, governments bailing people out, this is exactly what they're referencing as, because that's essentially what had happened in 2007 to 2009 was a bunch of people, decided that we could do these subprime securities, meaning risky security. Subprime is just a nice way of just saying, we're going to take a little bit of extra risk to get a little extra return. And they took all these risks. They got a little too big for their britches, and the government said, well, not the gov. We're going to say the Federal Reserve said, look, we'll go ahead and pay off all of those risks. We'll put this aside of us. We're not going to bail everybody out because somebody has to be made an example of. We'll call that Lehman Brothers. You can look that up. But that's essentially the system that we're living in now.
Exactly. Now, having done that review of the different, really, chapters of the book, we like to have these 4 counterintuitive claims that we lift from the book. We think they're counterintuitive, like the person off the street won't really realize them, maybe even through intuition, but we think they're true. So claim number 1, money is a hierarchy of layers. We talked about that. We're going to talk about it some more and dig into it. Claim number 2, layers scale, but add trust boundaries. We'll talk about scaling and trust boundaries. Layer 3, we mentioned the pivot layer. We'll dig into that some more. It's where all of the power is, and we're going to talk about how it has power. And then you have Bitcoin, which now, if you have this idea of layered money, you can start to reason about what Bitcoin is, and it creates a new pyramid. So that's counterintuitive because people may not know that Bitcoin has layers as well. And the response to that, you could argue, is the CBDC, so the central bank digital currencies. Now, claim number 1, money is layered. Again, monetary systems are hierarchical, and the author saying it's always that way. Upper layers are claims on lower layers. Again, this concept of claim is something to internalize in order to reason about money. Your money, the thing that you think is money, it could be an IOU, not settlement, right? So we have intuitions of, like, there's a concept of hard money. Oh, What is that? Something that has final settlement. People understand. Gold coin. Oh, I have that. All right. Or it could be, but people conflate that with paper dollars. This is where, when you're wrestling with the idea of money, you have a paper dollar and you think someone will take this and it's money. You don't think of it as an IOU anymore. And it's not an IOU anymore. You can't get gold for it anymore. So, how is it a bearer asset? That's all confusing. But having this layered idea, it helps you to understand the evolution of what that paper dollar used to be, and knowing what liquidity is, what we described earlier, will also give an explanation of why someone cares about a paper dollar. And then you have layered, uh, the concept of the layered map. It's going to tell you, in the author's opinion, what you actually hold. So here's a layered map. It's best to go through this from the bottom to the top. You have bearer settlement again. You have some of the properties of money. So the base or the base layer of the bearer settlement is going to have more safety, or it's just going to be safe in general relative to the other layers, right? But it's going to be slower, most likely. Then you have a layer above that. Now we're starting to reason about the current monetary system. So the layer above that now is the central bank money. We talked about reserves and cash, and they can have gold. We have Fort Knox. There may not be anything in it, but there's some gold there. You don't get claims on that, but they have it, or they say they do. And then above that, you have bank deposits. Counterintuitive as far as this being a layer. What do you mean bank deposits? You say, again, we said this earlier, but you, to make it simple, have physical dollars and you go to the bank, that's a deposit. And they give you a claim. What is the claim? I don't have a piece of paper. You have your account statement and you have the terms of the bank. And that's they owe you those dollars. Right. And then you have above that credit. So money market funds, we talked about this repo market stuff. You also have this concept of stable coins that we'll touch on. Those are even more convenient, but even more trust at the top layer. Why? They can cut off your credit card at any time. This happened in 2008, where a bunch of employers, people were paying, they had lines of credit, they're paying their employees' salaries, and they just froze all of it. And so all small businesses were hit and all this stuff like that. They really don't have to give you any of that money. So
Yeah. So and I want to say, these first couple of claims there, they really are linked because monetary systems are always hierarchical. Your bank deposit isn't money, right? Plain and simple, it's not real money. I'm going to reiterate that one more time. Your bank deposit is not money. It's a liability to the bank. It's a layer 3 claim when your layer 2 claim. Right? Remember what I said was each layer, there's a little bit more ability to manipulate every time you go up, right? The further that you are away from hard money, the more prone you are to it. So yeah, let's get into the next one.
So claim number 2, layer scale. Coins don't scale, gold coins, they don't scale to global commerce. Why do we care about that? Well, if you want to be able to buy things from a country that has a big giant labor force for very cheap, you have to pay them. So this is where we want, or people in power, or maybe even us, we want to have some way of doing this commerce. And the gold coins, sending them over on a ship, it's not going to work. So credit, you can reason about this again, credit and claims and all of this. You can reason about it as deferred settlement. You're owed money. It's a promise. You're owed something. Layers reduce transfer risk. So higher layers, they reduce the risk, right? Oh, we lost the gold coins. We put them on a ship and the ship sunk. Oh, that makes us sad, right? So it reduces transfer risk. And it also speeds up trade. So again, you could have pieces of paper. Now it's an entry in a digital bank account. But there's a cost. Now you depend, right? So layer 2 and above, you depend on the issuers of the claims, right? Think of claims as gold certificate. And you are also dependent on the rules, which they can change when they want to. The terms of conversion is how the author may say. Now, let's get into payment versus settlement. The idea or concept of what payment is. If you've ever worked in banking and we're in software, we have this idea of transaction, which is an overloaded word. People say, okay, there's a transaction, a bank transaction. So someone sent money somewhere else. I think this is a better way to, better language, an instruction to send. So payment is an instruction to send. Now that might be more counterintuitive. So if I did a payment with Visa, you had an instruction to send. Well, what is the instruction? It's an instruction from one layer, upper layer, to a lower layer. So settlement is final. Again, think of the bearer asset. You have paper dollars, you have gold, you exchange it, you give to someone else. It's final. You got to have to wrestle it back. The instruction is, someone sends, you give the instruction, that's separate from the gold actually exchanging. Most layers improve payments, instruction, right? Make the instance faster, but they don't improve settlement. So what is final? In a crisis, we talked about this earlier, but a crisis is when people no longer trust the claims and they no longer trust the payment network, right? So this based on claims, the instructions, so on and so forth. And they want what's on the lower level. They want the settlement.
And we can kind of relate this to if anybody who has a brokerage account, whether it be with, it could be Vanguard, Fidelity, Charles Schwab, just any type of brokerage. Your settlement account is usually your money market fund, right? That's when you sell off an asset like your equities, it goes to your settlement account. That is the settlement layer. That is what is final. That's what you can just redeem straight from your brokerage account and send straight to your bank account. That is it's in treasuries, money markets. That's what that is.
Yeah, it's funny to think about the layers and then their idea of what settlement is from this author's perspective. Can someone, if there's an issuer that you have to ask permission from in order to transfer, then it's not settlement in the author's opinion, right? So these words, you can kind of see where someone would want to overload the word and say, this is final settlement, whatever. It's like, wait a minute, can you take it from me? Yes. Oh, well,
Yeah.
I think I may have a
Yeah.
problem with it.
Yeah.
This
is
we're gonna get into that too. Go ahead.
Yeah, this is good wordplay and manipulation, right? I love to think of 1984 in those scenarios where it's like you can layer a word with several different meanings, and the end result is, if you're the ones that's creating this word, then you can define it however you want to, and people are just going to perceive it that way. But yeah, that's what I wanted to say on that.
Yeah. So now claim number 3, pivot is power. What do we mean here? We talked about pivot layers. The key position is between layer 1 and layer 2. So again, to reiterate, why? Because they're the ones that set the terms of conversion. You have the gold certificate and you have to go to the goldsmith or bank and they say, we're going to, on the certificate says right here, I need a 1 ounce of gold. Give it, you owe me it. And they say, not today, sorry. We're going to give you half an ounce because we feel like it. What are you going to do? They're the ones that set the terms and how much whoever it is. So you can go at a higher level of abstraction. Oh, I can sue them. I have regulation, all that. All of that is this term setting. Who all can set that? That's government at that point. Now, governments move to control that position. History, you had goldsmiths issuing coins, and people, they were ripping people off, that kind of thing. Then you say, well, government says, oh, we're going to come over, take this over. So you have Caesar or whoever Rome's making coins. Okay, fine. And so now they say, you know what? Now we can do the debasement and we could play. So they control the idea of moving from one layer to another, all this stuff. Then you have mandated denomination. We talked about that. What is that? We have someone saying, you know, during colonization of a country, the Europe would go into, say, some country in Africa, and they would say, you know what? We see all this activity you're doing. You're buying, selling shrimp or whatever. That's fine, but you're going to give us a tribute at the end of the year in this thing that we generated, these notes. So go on and continue on with whatever you're doing. But at the end of the year, know that we're coming and collecting these notes. So you probably should go ahead and exchange these notes when you're doing your own economic activity. And so that would be an example of a mandated denomination. Of course, we all are subject to that. When you pay your taxes, you got to pay in, like the United States, you got to pay dollars. Then you have the idea of, again, we're talking about power. So the central routing, right? So someone controlling this layer of exchange, it enables surveillance and policy. So we'll talk about CBDC's future, but this surveillance and knowing about the money flows, you can track relationships, and then now you can demonstrate or leverage any of this power over whoever's inside of that layer.
And this is, I would say, the most important claim. The key position is the pivot between layer one and layer two. This is where central banks have essentially inserted themselves by controlling conversion rules and routing of all transactions. They gained immense power, mandated currency choice, ended competition. I mean, it was no more. A central routing enabled, something Bhatia had highlighted as surveillance is a monetary feature. So, yeah, let's get into it.
Yeah. So surveillance as a monetary feature, why is that valuable to people who want to amass power? So if transactions route through a central layer, of course, whoever controls the central layer, they can see it. You have the operator. Who's the operator? Remember, the issuer person issues the capability to do any type of redemption, what have you. And you also have the custodian, the person holding the settlement for you. Right? So the operator gains visibility into the relationships. These are the money flows, capital flows, so on and so forth. Financial surveillance, now with digital, now you can have it at scale. Everyone can be viewed, and you can see all of the relationships. Why would you think that that's important? Of course, when someone says, oh, you're going to pay us a tribute, you're going to pay us a tax at the end of the year, well, they want to know who's not paying. So that's one thing. But you also have where if you want to, as far as a just reason, you have activity that would be something that you want to forbid, like money laundering, drugs exchange, and terrorism. Any of this economic activity, you can do it at that layer. So you have a certain amount of power there that um, you can stop final settlement on those layers, all these types of things. But with that power, you can have one government that does, right by you by enforcing it with things that you think are moral. But now you can have another government that comes after, and they're using it to enforce censorship on speech if they want to unbank you, what happened, so on and so forth. So the surveillance is a power play that you need to pay attention to.
Mm-hmm. And when somebody has full visibility into what you're spending your money on, right? Just think, I mean, there are regions within the world where if they know who you are, what you're spending your money on, the price of that good could go up if they don't if they have something against your demographic or the region that you are from, within a nation. That is, I mean, surveilling, and people really don't look into um how much privacy you truly do want where you spend your money. It you don't want your name to be linked to literally everything. And then I'm not even saying that this is, for something that may be, illicit activity or illegal. I'm talking about just with your everyday life, because it tells you exactly what you are doing, where you go. Like, say if you're buying your coffee every morning, you're spending money there, that traces it exactly back to you. If you are going to pay for, your lunch, that's maybe like right next to your workplace, that also identifies you as well. So this is surveilling and knowing where your money goes. But that's just aside, I mean, just for surveillance in general. Before we're going to talk about, CBDCs and all that other good stuff, but I just wanted to kind of set the stage for that.
Yeah, that's a very good point. With surveillance, you can make second class citizens on the private side or on the public side. If you have power and you want to create second class citizens for whatever reason, you can do that with the surveillance of the monetary side. So that would be an example of a non noble goal, right? And of course, government, but also surveillance on the private side too. Bitcoin is a new base layer, very counterintuitive. People looking at this, people think of Bitcoin as if you can't use it like Visa, then it doesn't work, and so it's done, right? So we're going to get into what this whole idea of Bitcoin and how you can reason about it with the layers. So 2008, that's a white paper came out. It added a new first layer money to history, which we're also talking about Bitcoin. Now you have settlement without a central router, so you don't have a counterparty risk. You don't have somebody who you have to trust in order to exchange, right? Again, you have paper, you have gold coins. There is no central router for gold coins, right? But the author brought up, oh, what about global exchange? You can't use gold coins. So now what are you going to do? You're going to have to go into this layer two somehow. Well, this layer one, actually, you can do global. So it is a settlement layer that you can have at the lowest layer. All right. So I mean, it's a type of currency that you could have at the lowest layer of settlement, but it's not designed for instant commerce. What does that mean? It's slow compared to Visa. It's slow. You can have, it's dozens of transactions per second instead of 65,000 transactions per second. So what are you going to do about that? How are you going to scale that up? Again, I'm not comparing apples to apples because Visa is also not layer one. But just as an example, people reasoning off the street, they're going to think about transactions at the speed. So what can you do? You can scale it up. And how do you do that? You add another layer. So you have layer one on chain, what's called on chain Bitcoin. You have private keys, which is settlement. We'll talk a bit more about that. If you don't have keys within the community of Bitcoin, if you don't have the actual keys, then you don't have settlement. You have an IOU, you have claims. Now, layer two, Lightning. We did a review of mastering Lightning to understand that. You can go and review that. But Lightning is a layer two in this sense. Now, we just finished talking about, oh, what about layer two? You have all of this risk. You have to trust a custodian. You have to trust an issuer. Well, Lightning is rules without rulers. So there's rules built into Lightning where the liquidity is provided, right? So you have an on-chain lockup of money. You have an on-chain lockup of Bitcoin. And then you have off-chain payments exchanging. But how does that work? The off-chain has a series of rules between different nodes that if there's a dispute, if someone cheats, then it's resolved on chain, but it's not resolved based off of some type of third party who can control the rules. That's the point. This conversion rule terms that I said for the issuer, they control the conversion of the rules. They can change it arbitrarily. In this scenario, the rules cannot be changed arbitrarily. So this is a difference and a different way to reason about a layer 2 when you're thinking about Lightning. Again, you could go back and look at our other references on this. Now, layer 3, you have paper exposure. This is the risk of the current last 4 years, what they call paper Bitcoin. What is this? ETFs. BlackRock has ETFs. You can also buy shares in a company that the company says, trust us, we're buying Bitcoin. And we're giving you a claim. That's the shares. We're giving you a claim. And it's in this sense, it's not with the shares of the company. It's not a claim on the actual Bitcoin, but we're giving you a claim on the value of an entity, the business, that the value is going up on Bitcoin. And then you have ETFs, which really is a claim on the Bitcoin, and they have various rules. So there you go.
Yeah. And those, what we're going to talk about with layer 3, those are what you would consider a spot ETF. And what that means in the financial markets is it means it's just tracing the value of the underlying asset. It's not the asset itself, but that's just the price of what the asset is at the time it is. So say, for example, if you wanted to buy gold on the stock market, right? You are buying it as spot. You are not buying actual gold. You're buying it at the value that gold is per the market today.
All right. Layered Bitcoin. Bitcoin becomes its own monetary pyramid, like we said. This is using the author's model of layered money and reasoning and using that to reason about Bitcoin. Second layer, you have claims. You have custody. Again, what do you mean by custody? You have these nodes and liquidity, and you have to have some way of exchanging. And so you have to exchange. If you have, like, could say your Bitcoin, and you're sending it through the Lightning Network, you're going to have to exchange it to one node, and that node's exchanged to another to create a route to the final recipient. That exchange, there's a certain level of custody, but that custody is enforced by rules that are not changeable. They're not arbitrarily changeable. So that's the difference between a custody or custodian there and a custodian of a bank if you deposited a bunch of gold there. Now you have the Lightning, this layer 2, it allows for more scaling. And so there's lighter weight payments. So you can change on Lightning, you can exchange a lighter weight. It could be, you can reason about it as it's faster. It is faster within seconds, not minutes, as far as like Bitcoin or even hours with Bitcoin. And then it's also cheaper. So you can send 60 cents for pennies on the Lightning Network. So that's something you can't do with, say, the Visa network. Now, another thing to keep in mind when you're talking about layers and you're talking about custodians. So who is it that holds the, let's say, gold coins, right? Normally, regulation goes against custodians. That's where, let's say, governments or people who want to have some type of power, exert some type of power over in the monetary system, they're going to put it on the custodian side. So if someone says it's time to seize your money, they're going to seize the custodian of your money. It's the bank, right? So that would be the custodian. The author, is just putting that out there because with these different layers, when you're talking about settlement and you're wanting to do something, let's say you live in a country where they're trying to just seize assets of everyone. If you have things inside of a custodian, which is a bank or some vault somewhere, that's where the regulation is going to go. But if you're the custodian, it's just that much harder for someone to work against you.
Yeah.
CBDC.
And I want to say, this is where, everything changes. And I just wanted to break this down real quick. Bitcoin adds a new layer 1 to history: settlement without a central router. It's a bearer asset settlement on a global decentralized network. It wasn't designed for instant coffees, right? So, like gold, it needs a layer on top of it. And just like with gold, a second layer of claims immediately emerges: custodial exchanges, lightning services, ETFs. Bitcoin becomes its own monetary pyramid, but with a crucial difference. The base layer is permissionless and outside of any state control.
Yeah, and I'd say the second layer is permissionless too, as far as like how we're
Mhm.
reasoning about it. So now
Mhm.
CBDCs are central bank liabilities. Okay, we're going to get in. This is quite confusing. So the idea of these central bank digital currencies, when it started making the rounds in the United States and people are thinking about them, it's like, well, what is this going to do for us? So people are thinking there's a dichotomy. There's a wholesale version and a retail version of CBDCs. The wholesale version is basically what the banks are using. That's not what you're using. And they don't care about with that version of CBDCs. You can think of it as an upgrade to really what is already there infrastructure wise, which is all digital anyways. It's another way for them to have a brand new ledger that's faster and better, all that stuff. But the retail one, that's the kind that would allow for the massive surveillance, people shutting off your money based off of you didn't spend it in time, or you're spending. There can be an issuance on, hey, you shouldn't spend it on candy, so we're going to take it off. It won't work for that. So you can do all kinds of things. Which we said earlier, you can make second class citizens if you want. Very easy. So this is retail. The author wants to talk about this as retail CBDCs, and that's what you need to worry about. But there's a problem with banks, and this is where interesting when this book was written was a while ago, and we're starting to see some of this happening now. You have a risk. So remember, we said earlier, what's part of the layered concept of money? You have bank deposits, which allow the bank to lend out, create, when they're lending out the money, they're creating money. So if they say, if you remember, we're going to come up, it's way worse than this now, but if you have a 1 to 10 fractional reserve rate, so they, for every dollar, you may not know, but for every dollar, they can lend out $10. When they lend out, that's creating money in as effectively on how you may think about it as someone who's, oh, I have a dollar, I can spend it, I don't care. They're creating it, but they're doing that based off of deposits, right? So they're supposed to be. Of course, it's not even 1 to 10 anymore, but they're doing that off the deposits. Okay, that's their business model, and they're collecting, interest payments, whatever. But there's a problem here. If you reduce the deposits on the existing system, they're not supposed to be able to lend out as
Mhm.
much. So now you have a problem. CBDCs, which is one movement, takes away from bank deposits. Why? Because you all throughout the world, instead of just the United States, you could use, well, you can, if not, I won't just say all throughout the world because that's stable coins, but people that are using CBDCs, there that could be outside of the traditional way of how the bank deposits are done. And it could be
Mhm.
that you have the haves and the have nots, the people who are wired for CBDCs and enabling them. You don't really need smaller banks anymore. So you can have this uh,
Yeah.
rolling up centralization.
Yep. Yep. And I want to go back to at the very beginning, we talked about the balance sheets being an asset equaling a liability plus equity, right? So for a typical person like us, cash is an asset. For the bank, it's not an asset. It actually sits as a liability. The loans are the asset because the cash is an IOU, right? So all of these loans that they're sitting, I mean that they're giving out, those are assets to them. That's what really matters is nice, profitable loans. So if you pull out the liabilities, right? They as Watson had stated earlier, You're not supposed to be making all of these loans if you don't have the deposits to support it. All right.
Yeah. So now with the and to expound on that, when people realize the um game of musical chairs, and they know, well, it's funny because if you reason about gold, then it's easy to understand. Somebody at the bank could very well, the vault doesn't have any gold in it, and that gets out, whatever. But the paper dollar, it's funny to when you think about this layers and all this, the paper dollar is just paper, and they're not even having that. It's just hilarious. But this is where we're at. The CBDC fork, right? Wholesale versus retail. We just talked about this. On one side, to think about, what the author wants you to realize is you have your wholesale, you have the banks. This is just an infrastructure upgrade. And then, but the retail, the public access, that's where you have all the policy, surveillance shift, and all this. In the United States, there's a massive movement to kill CBDCs. So when the author was writing this, it was a big scare. They're still on the left side here. You're still going to have the wholesale side. But on the right side, there's legislation to stop it in the United States. Of course, in Europe, they're going full bore into it. They have all this legislation to make sure that they're on it. Then you have the stable coins, which is basically the private version of this, and you have all of the problems there. So yeah, currency choice. Bitcoin enables the freedom of denomination. So this competition between types of money and layers. The trend is more currency choice and less monopoly. We're going to see, right? So wallets, Bitcoin wallets, you can hold Bitcoin. You can also hold CBDCs if they end up having that. Again, if you're in Europe and you're listening to this, watching this, you're dealing with CBDCs. And then you could also in the wallets have stable coins. Stable coins is a private version of the CBDCs. This layered map, talking about layers, layer 1, layer 2, layer 3, and this stuff, it helps you to navigate preferences. Remember, your preferences are at the lower layer, you have more safety. At the higher level, you have more convenience and speed. Again, how are you going to use this idea of layer? What layer are you holding? We talked repeatedly about what settlement is and what a claim is. What are you holding? Who is the operator? Who's the issuer? Who's the custodian? What can they do to you? Right? Nobody reads the terms of their bank. When you deposit money, it's a massive amount of fine print and no one ever reads it. But they don't have to give it to you.
Right. And then nobody's going to walk you through it either. It's just like, yeah, you know what the deal is. We're just like every other financial institution. Wink.
Yeah. And so what happens under stress? What's a run? People don't think about runs. They think they know about bank failures, but people going and getting and trying to get their deposits out of the bank, they really don't, even though it has happened. They don't really think about it. What about a freeze? If you're old enough, you went through 2008 and you may have dealt with it yourself, the idea of a credit freeze where you couldn't pay your employees, or you're an employee that couldn't get paid, especially in small business. And then censorship. We've seen the unbanking and censorship based off of speech. This is totally legal in Canada. It's supposed to be illegal in the United States, but it still happens. So you have that. So this is using an app. Some questions to contemplate for yourself. What layers your everyday money? For most people, this is going to be Visa. Right? What are the trust boundaries? Again, trust boundaries. What is that? Again, thinking issuer who issues you a claim. You're trusting them because they can settle. They can change the terms when they, whenever they want. And who's the custodian of your settlement, which you have a claim to, right? What does healthy layering look like? If you want to manage a risk, you have more risk the higher layers you are go, and you have on the lower layer, you're going to have safety, but you're going to lose speed and convenience. Wholesale, retail, CBDCs, we talked about that. Do we really care about that in the United States? Not so much. Europe, you do. What would you accept? Do you care about CBDCs? Some things to contemplate. All right. So conclusion. Money isn't one thing, it's a system. I think the author makes that pretty clear. Layers scale, right? So you can have faster, easier payments, more convenient payments, but they shift power to operators, again, issuers, custodians, the people who are controlling the conversion. Pivot layer concentrates control and surveillance. Bitcoin reopens a base layer choice. And CBDCs are one response to this. You could argue that stablecoins are another response. So, with understanding the layering model, you're going to have more clarity and optionality. You're going to know where your money sits.
Right. Right. And I mean, with that, I want to leave us with the one model, one story, and one action. The one model is this: always ask yourself, what layer am I on? Is this a settlement asset I control, or is it someone else's liability? The one story is the fight for the pivot. The entire history of modern finance is the story of institutions fighting to control the gateway between settlement and commerce, for convenience, of course. The one action is for everyone listening, tailored to what you're here for. If you're looking for an exit path, your action is to run a layer audit on your own finances. Look at your bank account, your 401k, your PayPal balance. For each one, ask 3 questions. What layer am I holding? Who is the operator? What happens to my money under stress if that operator fails to or censors me? Your goal is to move a small piece of your wealth from a high trust, high surveillance layer to a lower trust, self sovereign layer. And, that could be Bitcoin. If you're here to build the tools for this new world, your action is to analyze a decentralized project through the lens of layered money. Does it create a new base layer, or is it just another custodial layer, 2 or 3 claim on someone else's system? We don't want that. Is it building a new pyramid or just adding another floor to the existing one? The goal is to build tools that give users direct access to the base layer settlement, not just more convenient ways to hold IOUs.
I couldn't have said it better, especially for the builders. So if you want the companion links for this episode, they're going to be in the show notes, slides, one-page cheat sheet of layered money. We're going to have some of the other questions that we, presented there. If you disagree with what we're saying, go ahead and put it in the comments and try to put some evidence of what you're saying. We'll try to respond. And take a look at bitlemmas.com for more of the shows that we've done and what we're going to do in the direction. And I hope to see you again in the next episode.
We'll see y'all next week.